Andrew, thanks very much for joining us. Since I spoke to you on Thursday, any fallout from your comments around the bond market that it is almost corrupt? I have heard that you've been widely misquoted by the media, jumping on those news headlines, creating our own news out of nothing. But have you been contacted by the JSE?
I've had an email with Graham Smale, who's heading up the bond division of the JSE, but the JSE is working hard to fix this problem, so they were quite pleased to see some dialogue. I want to be clear, I did use the word the market is nearly corrupt, and what I meant to say is it's a bad market structure. It forces us to work on relationships, which means the big boys like Futuregrowth and some of the other big asset managers get a better deal than the small guys, and that to me is a form of corruption. There's shenanigans in placement processes where prices are manipulated down or allocations are given to friends rather than in a fair allocation. There's even shenanigans in the way instruments are bought back from the market, whereas the listing requirements for equities normally have minority protections and the like and don't allow you to cut separate deals. In the bond market, you see that kind of game. Now, to me, yes, I'm a big guy. My clients can probably benefit from that, but me and the people at the ACISA Bond Committee, and these are big institutions, know this is a bad market structure. And it's a corrupting market structure because it corrupts us all. I'm not saying a person is corrupt. I'm saying it's a holistically bad structure and we can do better in this market.
Andrew, don't you think that it's developed quite a lot, though, over the years, and that if you went back, let's say, 20 years, you would find the system was a lot, I don't want to use the word, it wasn't corrupt, but it was a lot more tightly controlled. There were fewer participants. Now I would argue that you've got more participants, there's more disclosure in terms of pricing, and that there has been some improvement over time.
Kevin, really interesting question, and I disagree wholeheartedly. I mean, I was trading bonds in 1992, 20 years ago, and yeah, we were at the floor then, and the floor was inherently, I mean, a bad place. I mean, there was a lot of front running by the floor brokers and such. Sorry, I shouldn't actually make that as an allegation. There were allegations of front running on the floor, but nowadays we've got basically four primary dealers who make the prices. So if you don't like the way one of them does it, if the back channel of communication about how you've just traded, he tells his buddies, you can do nothing about it because they basically own the market at this point. Now, that does not make, for me, a good, efficient market. We're trading on telephones. Telephones, when the rest of the world, trading almost everything in the world, trades live on screen with hittable and biddable prices on screen in a digital environment with full compliance and surveillance. It's ridiculous. We're living in the 18th or 19th century here.
You do mention that the bigger guys obviously get an advantage. How big is the small guys as a percentage of the market? How much, how many participants and how big are they in the bond market at the moment?
I would be lying to even give you an estimate. I think this is just a view that I and the members of the ACISA Bond Committee have taken, that it doesn't really matter. I mean, if we all go into the public park, it should be safe for the big rich guy to walk in the public park and for the small guy, the small retailer, the small institutional investor to walk in that public park. Or if you're going to drive on the toll road, I pay the same toll as you pay. It's just fairness. It's just an appropriate way to build a market. And by the way, I do believe that the structure of our market, its opacity in pricing, the fact that you really don't know where the market is or where it just traded, chases liquidity offshore, chases away domestic players from trading because it's not fair. And there's a lot of trade in South African debt happening offshore of all the ridiculous things. We must draw that back to our market because it's a fair, transparent, and efficient market.
Andrew, how would you change the system with regards to the primary dealers then? Remembering that, you know, only a couple of years ago, the government wasn't issuing much in terms of new bond issuance. It didn't have to do much, and the role of primary dealers was a lot more curtailed. What would you suggest is a better system?
Right. So it's interesting. You know, right now the National Treasury appoints the primary dealers to basically be the market makers in our market and provide liquidity. It has fairly light requirements for liquidity provision, but they really don't get paid for doing it. The Treasury doesn't pay a fee. They're an issuer in the market. They're the only issuer in the market who, by the way, doesn't have to pay any sort of placement or issuance fee. Normally, issuers do have some costs of accessing the public capital markets. And what they live on, it seems, is information flow. They want to see the flow. They want to see the trade. They want to see the activity so they can position their books. And that's not really healthy. That's just an economic rent being paid by investors to the primary dealers to make a market on behalf of Treasury. So there's a flaw in that. So what we see happening is a couple things. Treasury really needs to think about how they remunerate their primary dealers. We want more liquidity. They should be remunerated on liquidity in a visible market. There's general agreement now that we're going to move to what's called a central order book, which is an on-screen tradable market. Bids and offers on screen. You don't have to call anybody. You can hit the button and lift a bid or hit an offer on screen in whatever size is there. That way you start concentrating on liquidity. Those are the core. I mean, there's more than that, but that's the core of the argument.
Andrew, earlier today you sent an article on covered bonds for discussion. Now, I believe the big four banks were pushing to introduce covered bonds into the South African environment. We're not allowed them. And we've got to ask the question, why would they be doing this, considering they look as though they are nothing short of the devil's work? May I use such strong language, sir?
Look, I have a bit of an antipathy for the banks. Anything they want to do in the capital market, I assume, is going to be bad for my clients. So let me just declare that up front. But basically, we have to understand, what is a covered bond. A covered bond, if you think about what you are as a depositor and as a bank, now you as an individual or me as an institutional investor buying a bank NCD or a 5-year bond, we're what's called an unsecured lender, senior unsecured debt. That means we don't have specific security. We can't take the building if the bank goes bust. We can't seize certain assets. But on the other hand, nobody else can either. The banks generally have not been able to pledge their assets to any class of lender in South Africa. And what was happening with this concept of covered bonds was bubbling underneath the surface. There was a discussion going on because of changes in Basel regulations to banks that would allow banks to cede certain assets, the good ones, by the way, good assets, to certain classes of lenders, so-called covered bondholders. Now, what does that mean for us? It means that your deposit, when the bank goes bust, when you go to try to get your money back, what are you going to get? You're going to get a lot less. Me as an institution, same thing. I'm going to have been degraded by fiat change of regulation. Now, to me, that's just, we've made loans to the banks on a certain basis under a certain regulatory regime, and then poof, somebody decides that Switzerland in Basel, they decide we need new regulations and the banks can issue covered bonds. Well, that's a problem, and that needed a public discussion, which was not happening.
Andrew, then why, and I agree with you, by the way, but why do you think some countries do allow it, particularly a country like New Zealand, which is fairly conservative in most of its financial dealings? Why do they allow covered bonds?
Right. So it's part of a covered bonds and are part of a suite of regulations, and includes, for example, deposit insurance. It's okay in some countries to have covered bonds because the depositors are insured by a deposit insurance fund. South Africa doesn't have that and has no prospect of having that. I think we've been quite wise to steer clear of that, as we saw in the crisis. That's one part of the suite of controls. There's also going to be controls on how much can be issued. There's probably going to be controls on who holds them. In the South African context, what was going to happen, if my read of the regulations is correct, was banks could hold each other's covered bonds as part of their long-term liquid assets. So ABSA could issue covered bonds, which could be held by Standard, who could issue covered bonds held by Investec, who could issue covered bonds held by FirstRand, and so on around the daisy chain. So what you're going to have was all the banks putting themselves in a super senior position to all other depositors. Now, I don't know how it works in New Zealand and other countries, but I suspect there's limits on that. So it was a whole suite of regulations that had to come in, which was going to cause a major restructuring of the market. And as I say again, we've all made long-term loans, in many cases, 10-year bond investments in banks on a basis of being unsecured lenders, but nobody else could have security either. So it was going to be a degradation of the existing investors.
Bhavia again. Would you, as you mentioned, in New Zealand, there is a suite of possible, other regulations that would make this an acceptable, means. Would you see something like that as being better for South Africa, or would you say just stay away from it totally?
Look, our proposition, my proposition, Futuregrowth and acting as OMIGSA, our view was to stay away from it entirely. We didn't think we think there's other ways to solve the liquid assets problems for the banks. Certainly ceding assets is a major change in how you run your banking system. And we were very pleased after representations that the Reserve Bank affirmed in writing to the banking sector, you cannot issue covered bonds. So it does seem that the logic that they had affirmed previously several years ago was affirmed again now a couple weeks ago.
Well, it changed tack here slightly, Andrew. Looking at the IMF's June forecast, saying that global inflation picked up from 3.5% in the last quarter of 2010 to some 4% in the first quarter of 2011. Obviously, this is key to your environment. What are you anticipating going forward? Are you expecting inflationary pressure to increase across the board, both the emerging and developed world, or is it inflation in some territories, deflation in others?
Right. Well, it's exactly probably the point. The emerging markets really the hotbed of it. And I still think it's a second round effect from the commodity price spike we saw earlier, which is now stabilized. That said, the U.S. number last week was a little bit scary because it showed a broader base of inflation. It wasn't just commodity prices. There did seem to be some second round effects. Now, frankly, I don't think Bernanke minds that. I think he wants to see some inflation. He needs people to see prices rising, so they start borrowing and spending. But the market didn't like it. It destabilized the market at the tail end of last week. I still think there's a lot of deflationary forces in the world. I mean, there's just really There is excess labor, but beyond that, the housing sector globally, people are not borrowing, and the root of inflation is borrowing and spending. So we're just not seeing it yet. There's no money supply growth. So I'm not really worried at this point, and frankly, the U.S. Treasury bonds don't seem worried either. They're hovering below 3% at this point.